Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. Before we jump into our next episode, we have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.DealCatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review. We encourage your feedback. It'll help us make these episodes a better listen for you. And now, on to our next episode. Welcome back to our latest installment of the Credit Clubhouse. As always, I'm your host, Todd Anderson, Head of Content and Programming at DealCatalyst. We have a special episode for you today. Bruce Richards at Marathon Asset Management, joined by Kevin Bliss at the Virginia Retirement System to discuss the convergence of public and private markets. This keynote session was recorded at the DealCatalyst Private Credit Direct Lending Conference in Nashville on May 12th and 13th. Now, I'm going to turn it over to Bruce and Kevin.
Morning, everybody. Thanks for shuffling back for the keynote before break here. My name's Kevin Bliss. I'm a member of the private credit team at the Virginia Retirement System. We oversee about $20 billion worth of private credit assets for our pensioners. We're joined today by a man who needs no introduction, Bruce Richards, CEO, Chairman, founder of Marathon Asset Management. Bruce, how you doing?
Doing great, thank you. Thank you for being here as well, because I know you have a bunch of questions, but before we get started, big kudos to Kevin here, because he had to get a hall pass from his amazing wife, who is due in the next 2 to 3 weeks. So thanks for...
I'm really doing the hard work here.
Thanks for being here, Kevin.
Yeah, of course.
In labor, working here, right here.
Yeah.
For all of you.
Yeah.
And thank you to LSTA, DealCatalyst, for having us. You guys are amazing. What an amazing conference. 1,500 nearly attendees, and it's great to be here.
Yeah, we're going to have some rapid-fire questions at the end, so get your participation clickers here ready for that. But to kick it off, Bruce, why don't you give us the state of the union, your state of the union of the credit markets? What are some key themes that you're seeing today?
Well, key themes in state of the markets, if you went to sleep at the beginning of the year and you just woke up today, you'd see that equities are completely zero, no change at all from the beginning of the year to today. The S&P 500 is exactly unchanged in the year. And the high yield market started the year at 748. That was the high yield index. And today it's 748. So actually nothing much has changed in the year.
Yeah.
And so the state of markets is stable and no. So key themes. Number one, the golden era of credit really has become unequivocally the golden era of private credit. So that's number one theme. And the emergence of private credit has evolved to more than direct lending. Direct lending's been around for a long time. Middle markets, upper middle markets, lower middle markets, sponsored deals, non-sponsored deals, senior loans, stretch, mezzanine financing, unitranche, and all the different variations of direct lending. But private credit really has evolved into a big three, not headed, but 3 legs to the amazing stool that it is, which is direct lending. Asset-based lending's finally come of age, and it's a big, big marketplace. And I think when you look out 5 years from now, asset-based lending will be as big as direct lending. And third, opportunistic strategies, which is a catch-all for different types of strategies, including origination as well as secondary opportunities that are more opportunistic in nature as opposed to your typical par loan or ABL loan. And so it really is a great opportunity for private credit investors and private credit managers. The smartest people in the room have always been the private equity investors. and private equity fund managers, I think. And private credit has actually come of age where the biggest private equity managers have bigger private credit businesses now. And that's remarkable to see. And it's not only because of the growth opportunity, but also because of performance. And so you look at the performance and look at equity markets, I don't know, the average equity return this century over the last 25 years is 7%. Last 50 years, 7%, right? And volatility averages 16. It could be 30, 40, it could be 10, but the average for equities is 16. So vol is higher than the return by a factor of 2+. In private credit, you should be able to earn a 12 through funds with a 6 vol. In fact, if you look at vol for private credit, as far back as you can look at it, and PitchBook runs some numbers on this, and the vol that they put to private credit, 7.7% annual vol. And so the vol is less than the private credit return, unlevered or levered. And that's a pretty great place to be. So that's theme 1 is the evolution. Theme 2 is capital allocators are grossly underallocated to private credit. When you look at...
Don't look at me.
You? Yeah. You're doing pretty well, but most of these managers, they have a relatively modest allocation of private credit and credit relative to equities and private equity and growth equity and venture, and you add it all up, it could be 60, 65% equity exposure with maybe 10% exposure to private credit. But everyone, as you know, has a 6, 7% actuarial return requirement, whether it's for the pensioners, the DB plans, the DC plans, the public pension plans, insurance companies. And so to be able to earn a more certain return and then meet that objective is pretty good. So that's the second theme, is the allocation, I think, with the advent of ABL is going to allow allocators to double down on their exposure, because I don't think they take DL down any, but I think they build up ABL businesses and ABL exposure to be equivalent to direct lending. And ABL, more non-cyclical than typically what you find in direct lending, more uncorrelated to the market when you run correlations, and a similar type return. And so third, next theme in terms of big themes, and you and I were talking backstage about this, is this Basel III endgame, right? And so I think Basel III endgame is dead, and Barr is out at the Fed, and banks have built up these big CET1, the core equity, tier 1 ratios, and we think they have about $1 trillion in lending ability. They'll probably lend less to private equity and lend less on hard assets and lend more against folks that have loans, because they'll want to make a loan on a loan. It's better capital treatment for them and a better risk-adjusted return for them. And I think that's the way they move. And so I expect all of us to get increasingly more favorable financing rates this calendar year as opposed to last calendar year from the banks. And you'll see those financing rates ratcheting down. That's highly favorable to what we do. And finally, the final thing that I point out is how well private credit has performed relative to private equity. And so one of the largest, all the big private equity sponsors, private equity managers, and are public these days. The biggest of them are public, and they report their numbers. And there's one in particular that reported year-over-year private equity returns, as they broke it out in their earnings report, was 6.6% year-over-year. And this is a very, very good private equity manager, one of the best in the world, and certainly, hugely notable. And they have a huge credit business, and the credit business is, generating 11 to 12% returns. And so the return profile on lending in real estate versus being a real estate equity owner is also lopsided, where we're making so much more return as a lender than the equity folks are making as levered equity investors. And so that's also a big theme, and I think that will continue to be the case because I think, what you're going to get from equities is a 7% return. That's historically what you've gotten. And what you can get from private credit is 11 to 12. That's historically what you've gotten, received, and rates are going to be higher for a bit longer, and so I think you'll continue to receive that. So those are some of my big themes.
Yeah. One thing that you didn't touch on was the geographic exposure, U.S. versus Europe. What are your views there? Where, if you had $1 to allocate today, and you can split it up into quarters, I guess, if you want, but where are you allocating?
Yeah, good question. I mean, we hired a fellow named Alex Halley, ran Blackstone's opportunistic credit program for years and joined us a couple years back. He's doing a phenomenal job over in Europe, running our European operations. And we're seeing a lot of capital solutions in Europe. And we think that's capital solutions, can be, helping a company through some transition period. It could be, more growth capital, like a holdco pick preferred that, that you have equity-like returns structured as debt. And the company's highly profitable, but they don't want to raise equity because that's dilutive. And so, we come in a different part of the structure that allows the covenants to remain in place in terms of, debt outstanding, and yet allowing the company to grow. And these are highly profitable businesses. And so it's not a growth company that is unprofitable, but highly profitable businesses. And we're getting equity-like returns on a lot of these transactions. And so we're doing a lot in Europe and doing a lot in the U.S. But if you want a number, I'd say it's probably 75 U.S. versus 25 Europe.
Yeah, that's great. You mentioned your growth expectations a bit, direct lending, ABL, opportunistic credit. I think everybody in the room hopes that the private credit market continues to grow. As we think about this convergence with public markets and private markets and the growth of private markets, kind of overlaying that, what does that do to the illiquidity premium and the complexity premium that a lot of allocators have been attracted to private credit for?
Yeah, so two things. You talked about growth, so let me just unpack first growth and then answer your question more specifically. So in terms of growth, I mean, back in the GFC, the size of the global economy was like 60 trillion, and today it's like 90 trillion. And one thing that like the sun is going to rise tomorrow, is that the economy grows globally year over year. You have a year where you're in a recessionary period where it contracts, but over any long period of time, the economy is going to grow. And the economy grows in the U.S. and globally by about 2 to 3% per annum over any smooth line, over any normalized period of time. And with that, equity markets grow because you need equity cap to support that growth, and debt helps fuel that. And so debt will continue to grow. Well, public debt, high yield on the credit side, high yield loans, EMD, structured credit, all kind of the sectors of growth of public credit is growing by about 3 or 4%, a little faster than GDP. Private credit, when you add an ABL, is growing at 20% plus a year. And I don't think there's any time in the next decade that the growth rate slows from there, because the next fuel is going to come from ABL as well as a number of opportunistic strategies. So that's big picture. Now digging into your question about spreads and liquidity so when you have a growth that's that massive, I don't think you're going to have kind of the compression of liquidity spread or complexity spread, but like how much extra we get paid versus the public markets, maybe that's 200 basis points. Maybe for Marathon it's 300 basis points. No. but no, maybe that's 200 basis points. Maybe that's 250 basis points. I think probably half of it is liquidity premium, and about half of it is complexity premium. I think there's also some alpha on top of that through special sourcing and special relationships that you generate that's not explained by complexity or by liquidity premium. But that's kind of my general kind of neighborhood of travel in terms of what one would assign to what returns you're capturing. And I think kind of the bottom line or the punchline for that is, given the growth of the private credit markets, which isn't reversing anytime soon, despite Basel III, being, endgame being dead, and the theme that banks may be jumping back in, which I think is a false narrative, because that's not what the banks are doing. I think private credit will continue to grow by the same type of growth rates that we've had in the past.
Yeah, that's great. So you talk about Basel III. 6 months ago, you said it was dead. Today, you said it's dead. What implications does it have on SRT markets in the U.S., which has had a lot of capital formation around it over the past 12 months?
Yeah. So SRT's been alive and well and been a big part of kind of the capital solutions that banks and regulatory capital solutions that banks have in Europe, and they've been doing it for 20 years. And so it's nothing new. The Fed and the regulators fought this for years and years and years, and basically told U.S. banks, don't even try this. This is a gimmick. We don't like it. Make good loans, and they got the wisdom as to why SRTs are important to banks to be able to offlay some of the risk. Whether they do it in derivative form, whether they do it for securitization form, whether they do it for a typical SRT transaction, and so I think the U.S. banks are already full speed ahead on this, and they'll continue to do it, but rather than for their entire book, they'll probably look to do it on pieces of their book. Like, let me do it for my auto loan portfolio. Let me do it for my commercial real estate portfolio. And you're going to see a splintering of strategies, but is it here to stay? Yes, it's here to stay. We prefer, the biggest part at Marathon, the biggest part of their corporate book, and particularly the IG part of their corporate book, when we're entering SRT transactions. And we've done a number of them and put out significant capital in SRT transactions. We have a team dedicated to this that are calling on the banks and working with them on these transactions on both sides of the pond.
Yeah.
So that's our view. That's here to stay.
Okay, fair enough. Speaking of banks, over the past, 18 to 24 months, we've seen a number of asset managers partner with banks for various reasons. But what are your views on those partnerships? I believe Marathon has one, and how important will that be in direct lending to have those sorts of partnerships going forward?
Well, Kurt Luker, can you just come up here so you can answer that question for me? Kurt runs our direct lending business in the States, and yes, we have a partnership with a regional bank, and it's a great source of loans. Look, folks like to, folks being the private equity sponsors, they like banks. If you're in private credit, you think they only like us, direct lending. No, but the PE sponsors also like banks, and they're companies that they're acquiring. They like banks because they can use them for cash management services, the revolver, FX, payroll services, different services that banks traditionally, provide to to companies. And so banks will still get their flow of deals. And for Marathon or any private equity or private credit manager to have a bank as a partner, where not only can we source our own loans, right, but we have a bank partner that's exclusive to us, that we're, that's not skimming, origination fee, that, we can underwrite with them as loans are coming through and give a quick no or a very thoughtful yes, that we have a similar culture to them in terms of risk discipline, and it's the same type of program. It's very, very complementary. And so we love our partnership with Webster Bank. It's listed on the New York Stock Exchange, market cap around $10 billion, nearly $80 billion of assets on the balance sheet, with a really well-run team in private credit, direct origination, 60, 70-person origination team that's helping feed the Marathon machine as partners. And so, it's a really wonderful partnership that Kurt and myself and the Marathon team struck up with the bank, and I applaud others. And you see these partnerships, whether it's insurance asset manager partnerships, but this is one that's an origination partner, a bank origination platform with an asset manager. And it's a wonderful platform when they work well. And there's lots of them that won't work well for other reasons I won't get into, but ours is working swimmingly well.
Great. There's been a lot of press over the last couple of years around alpha in private credit, and does private credit generate alpha? I won't put you on the spot for that one because that's been.
Let's talk about it.
Okay, sure. Go ahead. Yeah.
So, I mean, does it? Look, when you make a loan, and I'm not going to disrespect anyone because you know how hard you work and how great of a job you do in underwriting every single loan that comes through your door and into your credit committee, and how great you guys are, everyone out there at various firms. So no disrespect, but if you want to kind of jump to making a loan, anyone can do it, and it's beta, and just go there for a second, although I don't agree with that, but let's just go to that statement for a second. Then the alpha is who has the lowest default rates. And if you have 0 default rates when the industry is 1% annual default rate, then you've created 100 basis points of alpha through your credit selection, through your tight documentation, right, that allows you to get paid at par. And so there is alpha to generate by picking the right companies, non-cyclical companies with low turns of leverage relative to higher turns of leverage, with strong covenants, with strong sponsors that are doing a great job managing those businesses and helping those businesses grow. And so there's definitely, alpha to be generated by credit selection and by keeping default rates, low relative to the peer, relative to the industry experience.
That's great. Well,
I'm sorry, what was the question?
No, but you answered my question, which was what levers are your team pulling to generate alpha? And so that was a great.
It's great relationships. It's great relationships with sponsors. It's dealing with sponsors that that are not fundless sponsors, but real sponsors that have real success and a real track record. And when you're looking through their data room and you see the deals they've done successful deals. And so now there's a bias selection to dealing with a certain cohort of sponsors that is very, very favorable. And then it's what industries you want to avoid, and what industries you want to lean into, and what companies have the best margins and the best margin of safety when you're lending against, and who's got and what can you negotiate in terms of covenants and spreads, and there's a lot of things that go into and being able to make a quick decision after doing incredibly thoughtful work.
Well, let's unpack that a little bit. So there's a lot of competition in the markets today. What are you avoiding?
Well, that's going to be a very sensitive topic here. I don't want to insult anybody. And so let's talk about the easy one first. So cyclical, consumer, discretionary businesses, avoid. We've been doing that for some period of time. We're very happy with our decision. We see what the loss rates and the difficulties some of those businesses are going through, whether it's tariff-related, whether it's just commodity-based businesses where margins are getting squeezed and so forth. But the big elephant in the room that nobody's talking about, again, private equity is now talking about this. But the credit guys, the lenders, and gals, are not talking about this. It's the elephant in the room. It's the dinosaur. It's let me over-dramatize this one, but it's the creative destruction that's at the doorstep of companies in this industry subset. Software companies. It used to be 15 years ago, software companies were too risky to lend against. And then we all woke up to ARR, right? And the reoccurring revenue and the stability of the industry. And Mark Andreessen's famous words, Mark Andreessen, Andreessen Horowitz, A16Z, famously said, software will eat the world. And it has. And the amount of value creation in software has been astronomical. And there's no disruption coming the way of Microsoft or Oracle or Adobe or Salesforce. I mean, they're embedded, they have moats, and they're going to use, well, those two letters, AI, to their advantage to set incredibly higher valuations. But now let's go to the 5,000 software companies that are owned by the private equity community in US and Europe. You know, the top two private equity sponsors that dedicate to software own hundreds of these companies, right? And no disrespect, but like think about the vintage of 21 and the multiples these companies were bought at, 9 times, you know, debt to EBITDA, and there's 2 turns of, extra leverage because we do these add-backs and adjustments, nonsense craziness. But I'm not even going there. I'm saying this. AI is going to be incredibly disruptive to software. And you don't know underwriting a software company today. You just don't know, in our humble opinion, if you can actually underwrite that company. Because will AI, it's like that Blockbuster Video moment. It's there until Netflix comes around, which is a smaller company, and then they're gone. And what's recovery value? You know, Kurt said don't say 0. But it's going to be a very low number, 10, 20 cents maybe. And so when you're looking at a portfolio of private equity software companies, love. Because you have all the upside and value creation from AI. But you're also going to see more zeros than you're traditionally used to as a private equity sponsor. But as a lender, you don't want to see any zeros or any major losses when you lend. And I'm just saying the risk is so high for AI disrupting. So the AI agent, and I'm not sure if you've studied this company, our Cursor, right? And the billions of lines of code that they're writing that can completely disrupt your company. So you have a company and it's software for, I don't know, the hospitals, right? It's software that a bunch of hospitals use, and there's a bunch of them, and it's clunky, it's always breaking. You talk to the nurses and the people behind the front desk, and they're completely complaining, they're always complaining about it. And how can AI come along, and your AI agent, and 3 people, and create a much more efficient system at 1/10 the price, and all of a sudden, bang, you're Blockbuster Video. And I'm not saying it's going to happen this year. It's not going to happen this year. You're good this year. But if it's a 5 or 7 year loan, yes. Yes. To a reasonably large cohort. Default rates are 1/3 in software compared to the industry of default rates. Will be 3 times the rate of what the industry is. Default rates cumulatively below or above 10%, I'm taking over. It's the elephant in the room that none of the lenders are talking about, and a huge cohort of lenders have enormous exposure to sector because it could be for some lenders that leaned heavily 30, 40, 50% of their exposure. For others, it could be 10 to 20%. It's big exposure. It's what we're kind of like. And if I'm wrong, I don't think I am, but if I am, then we missed an opportunity to lend to that sector. And we're lending to other sectors and getting the same return. Got it.
Well, now that we're all depressed, we have a couple of minutes left. You want to do some rapid fire?
Yeah, but I'm sorry to be the bearer of bad news, but
good.
listen, it's going to happen whether I said it or not. So, the fact that I said it means nothing because it's either going to happen or not happen. Yeah. You can say that guy Richards is an idiot. Remember what he said 5 years ago? 5 years from now? Or, wow, that's the first time I really thought about that. And thanks for saying that because I hadn't been thinking about that. But AI will be hugely disruptive, I believe.
Yeah. All right. So we have our first poll. I don't disagree, but yeah. No.
There you go, Kevin. You heard it from Kevin.
No. Yeah.
Kevin Bliss right here, making the call.
Yeah. Question 1 of our poll is active. Bruce, to ease or not to ease?
Not to ease now, not in June, not in July, and not last week, certainly. I think the first ease, is probably September at the earliest.
Looks like most people agree with you.
Survey says, we see that in screen?
Yeah, right here.
83%? Okay.
86, yeah. We can bring up
86%.
question 2.
Okay.
Oh, should we do some?
Yeah.
Should we do some audience questions? Uh-oh, it got taken away from us. I don't know that that's ours.
Okay.
Okay.
However you want.
How are you using AI today in the operations of Marathon?
Everyone is, starting to use it. We're building all of our bots to make people that much more efficient. Analysis to be able to listen to, 1,000 earning calls and summarize it. When a human can only listen, to a subset of that. So
Yeah.
Here, recession or no recession? What's the question?
Yeah, recession or growth in the next 12 months. What do you think?
Recession, 73%? Wow. So Goldman Sachs and JP Morgan just today doing the, Michael Jackson moonwalk, walking it back with their no recession call after being, it's definitely happening. I'm a not happening, no recession. And so.
Well, that's good. That's a nice positive thing to end on, at least.
Well, yeah, I mean.
Well, none of us are going to have jobs in 5 years, I guess, but at least there's.
No, we'll all have jobs. We'll all have jobs. I don't believe AI is going to do that.
I guess the last one, if you're allocating $1 today, are you putting it in private equity or private credit?
Private credit, definitely.
Let's see what the room says.
The audience is 100%.
Yeah.
You got to love the DPIs.
Stomp the count. Stomp the count. No.
You got to love the DPIs because when it comes to private credit, you know what your interest payments are.
We know our
what your maturities are, right? You know what your DPI is going to be and your distributions are going to be. And private credit's been nailing it. And so, I think private credit is going to take a bigger part of the allocator's wallet in the next couple years relative to private equity, relative to what it had done historically. So.
All right, stop the count. We got
the last one right here.
Well,
default rates.
Okay, default rates up or down?
Up or down. 100% thinks it's up. I'm kind of in the middle. I'm thinking it's been up, and I think it's going to go more sideways from here. It's going to stay elevated at an elevated rate, and maybe it goes up just a smidgen, but I don't think it goes. I don't think it goes down, but I don't think it goes up horribly from here because I'm a no recession person in this next 12 months. I think growth is going to be okay. It's going to slow. It's going to have higher inflation potentially, but today's CPI number was great. Core CPI came in really well, under 3%. 2.3 and 2.9 respectively for CPI. So I think inflation is going to be better behaved than what people have been thinking, and the tariff that's going to be coming through, that 10%, it kind of like baseline, which I think, the administration is going to manage to over time after shocking the whole system, is not inflation that's ongoing. It's a one-step function up, and then you kind of go sideways from there. So I think it's slightly higher inflation, and then slightly followed by slightly lower inflation because of the nuance of what a tariff implies. Kevin.
Thank you.
Thank you.
Yeah, appreciate it.
Okay, thank you, everyone.
Thanks, everyone.
Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. We have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.DealCatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review.